Because we can learn more from others' mistakes than we can from their successes, today we're going to discuss the 5 common property investor mistakes that are not related to buying the wrong property.
Are you interested in property investing, success or money? Well, you're in the right place. This is the Michael Yardney podcast, where each week you'll learn a number of new ideas regarding success, property investment and money in 20 minutes or less. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, who has once again been voted Australia's leading property investment advisor. That's the 4th time he's won a similar award in the last 6 years.
Welcome to this week's show, when we're going to discuss the top 5 mistakes that property investors make, apart from buying the wrong property. Welcome to all the new listeners. Every week we're getting hundreds of new listeners, and I can see that because we're ranking very highly in iTunes amongst the business podcasts. But I really appreciate all of you who keep coming back. So this year we're going to have lots more great content, and today I've got a special guest, Stuart Weems, Director of Pro Solutions Private Clients. You see, if you want to build wealth by investing in property, it stands to reason you're going to be interested in learning the mistakes that other investors have made so that you don't make those mistakes. And I've written a lot in my blogs, and you've heard a lot in my podcasts about how to choose the right properties, how to choose what I call an investment grade property. If you haven't listened to podcast episode number 1, go right to the end of iTunes or on the michaelyardneypodcast.com and have a listen to what's an investment grade property. Also have a listen to the things I speak about using my top-down approach. But let's assume you've got the right property. There's so much else that you can do wrong, so we'd like to help you get it right. And that's the subject of my chat today with Stuart Weems. Before we get on to that, I just want to remind you that once a year I do a series of seminars around Australia. These one-day trainings, there's no sales of properties. It's giving you lots and lots of good education. And I'm doing it with Dr. Andrew Wilson, Australia's leading property economist, Ken Rayson, local property and finance experts. And they're coming up real soon, so why don't you go to propertymarketupdate.com.au and find out all about them. By the way, as a listener to my podcast, I'm offering you to come along as my guest rather than pay $99. So put in the coupon code podcast at propertymarketupdate.com.au, and I'd love to catch up with you when we're going to explain to you about the new reality of property. Anyway, back to today's topic, the common mistakes that are not related to buying the wrong property. A short while ago, I caught up with Stuart Weems. Let's hear how that conversation went. What can we learn from other investors? We can learn from their successes, and we can also learn from their mistakes. And that's what I want to discuss today with Stuart Weems, Director of Pro Solutions Private Clients. Welcome, Stuart.
Thank you, Michael. Thank you very much for having me.
Now, you've been in the property investment field for a long time, but you come from a very holistic view, having an accounting background, a financial planning bent, and also mortgage broking business. So you've seen investors have some good times and some difficult times. What do you think are the common mistakes that investors make so that we can learn how to avoid them?
Well, firstly, Michael, I'd say that very few mistakes are caused by random bad luck, that most mistakes are very predictable, which is good, I guess.
That's good. It is good.
Because we can educate ourselves or go and get some good quality advice to help us avoid those mistakes. So I think the first thing is that the quality of our assets determine our outcomes. So I know your podcast talks a lot about property and asset selection and so forth. So I guess putting asset selection aside, assuming we've bought the right property or the right investment, what else are we getting wrong? So I think there's probably sort of 5 common mistakes. The first one's really about tax planning. Now, I don't want to be really tax focused because ultimately if you're paying tax, you're making money and that's a good thing. You don't want tax losses. They might be very tax efficient, but it means you're losing money.
So your point really is you shouldn't be buying property for tax. Tax is the cream on top. But that's where we see people, I'm sure you see it at the end of the financial year, I've got to buy something quickly, I've got to get some negative gearing this year, I've got to not pay so much tax. Wrong focus, isn't it?
Correct. Tax savings or negative gearing benefits are a consequence of building wealth. It's not the primary reason for undertaking a property transaction. But I guess what I'm indicating is there's a couple of different taxes for people to start thinking about, particularly property investors. So certainly you get some gearing benefits at the beginning of the journey, but if you plan to hold this property or a property for a long term, you need to think about the tax liabilities in the future. So the property will start generating income and you'll pay tax on that income. And then if one day you sell the property, you'll pay capital gains tax. So you need to balance out these things like land tax as well. It's a bit insidious because land tax when you first start investing, it's not a big deal. You might pay a couple of $100 a year. But if you hold the property for a 20-year period and it has a strong land value component, which it should, land tax will start to really eat in a time when you don't want it to. That's a time in retirement.
So I guess what you're saying is begin with the end in mind. What's your portfolio going to look like in 10, 15 years' time? What is your personal situation going to look like? Are you going to be working, aren't you? Whose name do you want the income to go in? And that's where you should get some structuring advice before you buy your property, because once you purchase it, it's a bit too hard and too expensive to change.
Almost impossible to change because it's cost prohibitive. But exactly right, Michael. I'm saying take a balanced view. So certainly in the initial stages of a journey, someone buys their first property, negative gearing savings are quite important. But with each individual purchase, additional purchase, I should say, negative gearing starts to become less and less important, and future tax consequences like land tax, like capital gains tax, start to become more important. So take that balanced view.
It's always a difficult balancing act when you first start off because your priorities when you first start, when finance is tight, when cash flow is tight, seem to take a precedence. But you really do have to take that long-term view. So getting the right structures, and in particular tax structures up front, is mistake number one, or I guess lesson number one, Stuart. Let's get it right. What's the next one?
Managing your borrowable equity. So your borrowable equity is really how much you can go to the bank and how much will they lend you. And obviously it's determined by your income and the equity in your properties. Obviously, when we first start our investment journey, our financial position is at its weakest. And obviously, after many, many years of investing, we hope that our financial position will be a lot stronger. So managing your borrowable equity in the first 5 to 10 years of your investment journey is absolutely critical, because the sooner you can acquire the assets that you need, if you decide you need 3 investment properties, the sooner you can acquire those assets in a deliberate and safe manner, the better off you'll be in the longer term because of the effect of compounding capital growth. So don't worry about interest rates. Don't worry about valuation fees or refinance costs or so forth. The name of the game is to get access to as much money as you safely should borrow and invest that money as soon as possible.
So you've got to make yourself attractive to the banks because, as we've said before, real estate investing is really a game of finance, having the right finance strategies, having the right financial buffers, and having the ability to buy the next property. Part of that comes from what you said right at the beginning, owning the right asset, one that increases in value. It makes it easier to get the next deposit. But the other one is serviceability, and currently at the moment, it's harder. You've got to make yourself attractive to the banks.
Exactly right. And the other component there, Michael, is bank valuations. You know, I remember it was many years ago now, I had a property in Paran in Melbourne, and I had one valuation at 1.2 and another at 1.6. So a $400,000 differential, same property, same valuation time, 2 different banks. So one meant couldn't buy another investment property. The other valuation meant could easily buy another investment property. So there's lots of strategies you can do to maximise bank valuations, but that's a key component.
Sure. So you've got to have the sort of asset that the banks like, and we know there are certain properties they don't like, and we can go back to previous podcasts where there's an episode, just do a quick search on the Michael Yardney podcast on which properties to avoid. And also you've got to today be even fussier about having a good credit history, having a good employment record to make yourself attractive to the banks. What's another mistake we should try and avoid, Stuart?
I think if we find we're digging out a hole, I think we should stop digging. So,
what do you mean by that?
if you're investing in the wrong asset, I think sometimes we see what we want to see, and we convince ourselves. And you know, there's a lot of psychology which you talk a lot about, Michael, behind investing. So if I'm going to go and invest in a property, I'm going to look for all the reasons why I think it's going to work.
It's called confirmation bias.
Yep.
What football team do you barrack for? I bet you if it's different to mine, you'll have a whole lot of good reasons why they're the best team, or why you use a Samsung and I use an Apple, when in fact you look for information to confirm your initial biases. Or if you've bought it and you're so emotionally involved, it's actually very hard. That's why you really need to sit once a year with somebody independent, in my view, who actually can look at your assets and say, how are they working? Are they working well? And it doesn't matter what colour the property is or what suburb it's in. If it doesn't work, you've got to take a harsh view, don't you?
Exactly right. And property is part art and part science. You know, you can look at the analytics of it. You can look at the past growth and these sorts of things, but it really it doesn't always tell you the full story. Part of it is a bit of an art to it as well, but you should be able to point to the reasons, fundamental reasons, why you've formed a view that this property will grow in the future. And I think if that view is different to its past growth, you really want to have strong reasons for that. So if you're investing,
I call that speculating, Stuart. Yeah. So I think you really have to understand, knowing what I know now, if I was to buy that, would I really buy that property again if it was on the market? And then you've got to look at the cost, because there is cost with getting in and getting out. But Stuart, what I often say is, if you've got some employees and if one of them came to work late and played on Twitter and Facebook all day, went to lunch and didn't come back and see the clients or the customers, what would you do? You'd actually do a performance review, which is basically what we're talking about right now. How is your employees, your properties performing? And then what you'd have to do is decide, well, maybe I've got to pay a redundancy package. There is a cost in it to get rid of this employee to get a better one. I remember many, many years ago reading one of your blogs, Stuart, it's still in my mind, that if you can only buy 3 or 4 properties, you should really own the best 3 or 4 properties you can, rather than just any 3 or 4 properties.
So the scarce resource we're dealing with is borrowing capacity. Everyone has a maximum borrowing capacity, no matter how wealthy you are, and then it's just about allocating that resource as best as possible. So sometimes I find clients that have properties they've owned for a long period of time, they say, well, Stuart, it's not actually costing me any money. It's paying for itself. How often do
they say that?
Yeah. Well, it is costing a lot of money. Firstly, it's utilising a scarce resource, borrowing capacity. It could be put towards a better asset. And then you've got the opportunity cost component, which is the most considerable. So, you know, there's never a bad time to buy a good asset. And I think there's never a bad time to sell a poor asset.
I think that makes a lot of sense. Interestingly, only last week I spoke to somebody who bought some properties in regional Victoria and said exactly those words to me. Michael, it's not costing me anything. And I said, yes, it has. You've missed the biggest property boom of this century, the 21st century, by owning secondary properties. And imagine what would have happened if you would have had that asset in Melbourne, Sydney, or any of the other big capital cities.
Yeah, exactly right. And it's a big mistake.
So we've gone through some of the mistakes people are making. One of the ones I'm seeing currently, Stuart, as our market has slowed down, is people trying to time the market.
Yeah, it's a problem, and it's a problem created by worrying about short-term market movements rather than having the discipline to make long-term investment decisions. You know, when Warren Buffett invested in Merrill Lynch in the middle of the GFC, people couldn't believe that he did it, you know, because the banking industry was really on the nose at that particular time. I think I read recently he made $3 billion from that transaction. And because it was a bit counterintuitive, but he took a long-term view. He knew Merrill Lynch has been around for hundreds of years. He protected his downside risk, and he really couldn't lose from that deal. And in hindsight, and we're all smarter in hindsight, it was a bit of a no-brainer. So don't worry about what the market's doing, what the media is talking about, what the interest rate predictions are for the next 1 or 2 or 3 months. Quite often they don't predict much longer than that, so it's pretty useless, really. Don't wait for signs or indicators or your life to be perfect, because it's never really perfect. I don't think there's been one time when I've bought property where I thought, everything's lined up and I have no concerns and nothing
if you
will change.
thought that, you would have been wrong.
Yeah, exactly right. I have my head in the sand. So it's never going to be perfect. So what you need to do is just run your own race. When it's safe and reasonable to do so, you should go and invest. And when it's not safe and reasonable, you shouldn't do it. And you should just take a long-term view. You should say, the decision I'm making today, I want to be much better off financially in 10 or 20 years' time. Don't really care about what happens over the next 5 years. But as long as that property doubles in value, as long as it's worth twice as much in 10 years' time, it's a good decision.
That makes a lot of sense, because you will find that the experts can't time the market. It's easy to look in retrospect and see all the signs, but during the bottom, when all the noise is there saying how bad things are, people are the most pessimistic when they probably should be the most optimistic. And we saw last year, when the markets were booming, particularly in Melbourne and Sydney, that most people who were optimistic should have realised that that time was coming to an end as well. So there's a bit of a theme going through this whole conversation, Stuart, that having a long-term view, wealth is the transfer of money from the impatient to the patient. Property investment really isn't a get-rich-quick scheme at all. And Stuart, one last one. What is your last big mistake that you'd like to share with us?
So starting with the end in mind, I find that if people don't really understand what their end goal is, and I appreciate if you're in your 30s or 40s, it might be difficult to think about what you want out of life in your 60s and 70s. And without a doubt, I'm sure your opinions and preferences and desires will change over that time. But not having some sort of goal, not having something to aim for, is a recipe for a disaster, because you either underinvest or overinvest. So you just need to work out, okay, what do I want? By the time I'm 60, I want the flexibility to not have to work anymore. I might choose to do some work, but I don't want to have to go to work. What does that mean? Well, I need $80,000 a year after tax for general living expenses, to fund my retirement, and then just look at what assets you have today and work back, and you can work out what sort of assets and what you need to invest in over that period of time. As I said, underinvesting, overinvesting. So people aren't procrastinating or taking too long a time to acquire the assets that they need. And the shorter amount of time, the higher risk then you have to take. So if you don't realise that until your 50s and you've got 10 years left, you've got to do some pretty heavy investing over that period of time. Or sometimes people overinvest. So I can remember a client many years ago that I said, no more property. And then a week later, she rang the office and said, I bought 2 more on the weekend. And over the past 7 years, she's had to deliberately sell down this portfolio of properties because it was just costing too much to hold. And as a consequence, she's really lost a lot of opportunity costs, because they're excellent properties, they're outstanding properties, and they're going to be worth a hell of a lot more in 10 years' time. And if she had just stopped when I said stop, I'm probably saying I told you so in a way, but it would have been sensible. So not over-investing can be a problem at times too.
So I guess it means having a plan, having a strategy, understand how you're going to live off your properties at the end as well. And I think it's really important to recognise that residential real estate is a high growth, relatively low yield investment. So if you're going to make the plans in the future, and you've got to have a rough idea of what are you going to need to live on, I find it really interesting that people's estimates of what they want to live on changes. A lot of people all say the same. They all seem to say I want $100,000 a year.
Yeah.
But they don't recognise that in 10, 15 years' time it's not going to be as much. So they probably need double what they think to live on in retirement, and probably twice as many properties as they recognise, because 2 or 3 properties without a mortgage isn't going to get you where you need to be.
No, well, you've obviously got superannuation. So how I see it for most people is it's a kind of you fund retirement in 2 phases. Your superannuation can fund the first phase of retirement, and because property needs a long time to really generate significant, and I'm talking about really significant returns, then property will probably fund the second phase of your retirement. So if you have a lot of super, then you've got a lot of time up your sleeve to let your property portfolio deliver some good results. If you have less super, then obviously you need to start thinking about your property strategy needs to be a little bit more complex.
Sure. Well, I guess that's the benefit of having your mixed, blended background of having the accounting, the financial planning, the mortgage broking background. So Stuart Weems from Pro Solutions Private Clients, thank you very much for giving us those 5 tips. So the investment mistakes to avoid are not having a proactive tax planning strategy at the beginning, similarly not having a finance strategy at the beginning also, and having a borrowing capacity that'll see you through with finance, wasting time by owning the wrong assets and not getting out. If you're not accepting the fact that maybe the property isn't working how it should, trying to time the market. And the last mistake you shared with us today was not starting with the end in mind. And if people want to find out a bit more about your services, Stuart, how do they do that?
They can just Google Pro Solution Private Clients or my name, Stuart Weems, and many articles and blogs and all that sort of stuff will come out.
Sure. Well, also, if you go to Property Update, my daily blog, Stuart has regular columns there as well. Thanks for your time, Stuart.
Thanks a lot, Michael.
Well, there you have it, the end of another show with a great interview with Stuart Weems as we discussed those common mistakes investors make apart from buying the wrong property. And at this stage of the cycle, in this new phase of the property market, it's going to be very easy to make mistakes. Some of the things you did in the previous years, some of the strategies you used, in fact, even some of the properties you bought may not be appropriate at this stage of the property cycle. Now, that's going to be a tough decision for some people who bought properties expecting different outcomes that are going to happen at this stage of the cycle. And that's one of the reasons I'm running a series of seminars around Australia. They're one-day trainings with no properties for sale. You know, we've never sold properties, and it's an educational seminar that I've been running now since 2002. And what I'm going to be discussing with Dr. Andrew Wilson, Australia's leading property economist, and Ken Race, and local property and finance experts, is what's happening in the property markets currently and how you can take advantage of them and the mistakes you should avoid. Different things to what we discussed, different mistakes to what we discussed in this show. So if you'd like to come as my guest, the normal tickets are $99, but this year, because my podcast new, the first year I've actually had the podcast when I've done this series of seminars, I'm offering all subscribers to my podcast an opportunity to come along as my guest. Go to propertymarketupdate.com.au and enter the coupon code podcast. propertymarketupdate.com.au. Use the coupon code podcast and come as my guest. Thanks for listening. If you've enjoyed the show, tell a friend or two. That's my payment. That's all I'm asking. And I look forward to being in your ears next week.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property advice. If you got value from listening to this podcast, please leave us a review and we'll read it out on a future show. Just go to michaelyardneypodcast.com/review and it will take you over to iTunes, where you can enter a review and let us know what you think. We'd really appreciate it. If you don't already subscribe on iTunes or on your Android phone, you'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes or a transcript of the show, head across to michaelyardneypodcast.com. Watch out for our show next week. You'll learn some new ideas about property investment, success and money in around 20 minutes.